The debt markets, I'm not going to talk too much on the debt markets because Steve's going to talk about that, but from the peak to the trough, there was about a 2 turns in EBITDA that the leverage was reduced by. So at one point in time, you could borrow 5.5 times leverage, and then it went down to about 3.3. I'm going to go through this busy chart just for a second to show how that impacts valuations. So if I go to the far right, what we have is a business that does $10 million of EBITDA. It grows at 7.5% a year. And if you go to the far right and assume the private equity investor wants a return of 25%, he will pay $83 million if he can put 5 times debt on it. And you can see that 25% return. If you go to the left, where he can only put 3 times debt, and he wants a 25% return, he will pay a $50 million valuation. So for the private equity person who's very much IRR driven, if he can put 5 times instead of 3, this purchase price goes from 50 to 83, or a 67% increase. It's a huge difference. The other ways to look at that is you can see the light blue going across, and it says equity returns at an $83 million valuation. So if the private equity player stays at 83 and only puts 3 times debt on it, he will get a 15% return. And if he can put 4 times debt, he will get a 19% return. So what's going to happen? He's either going to take lesser returns or the owner's going to take a lower price. And then the last column says, you know what if this business can grow faster than 7.5%? How do I get back to that $83 million value? So if you can grow at 20%, you can put 3 times leverage on it and still get that 25% return for the private equity investor. And if you can grow at 13%, you can put 4 times. So these are some of the levers that say, geez, I really want to sell my business for $83 million. What are other ways to do it? And if you can grow faster, you can do it. Or you can sell it for a little less price. And then the other thing we talk about is this is from a private equity player's perspective. The strategic buyer's cost of capital is so cheap that he will compete and take those 14, 15, 16% returns. So one of our other themes is you're going to see the emergence of the strategic buyer back, given his cheap cost of capital. Debt markets, just quickly, I think one of the parts of the debt market that is not doing well and won't for a while is the syndicated market, which is really ratings by Moody's and S&P that nobody trusts. But one of the things that replaced that is the high yield market, and that's just the search for yield for people who are tired of getting 0.000025 in my bank account. But it really has replaced, to a large extent, the syndicated market. And a lot of companies here aren't high yield issuers, but a lot of the buyers out there are high yield players who are buyers for lower middle market companies. And if you think of Petra Hawk, Chesapeake, Landry's, Goodyear Tire and Rubber, those are all high yield issuers. So the high yield market is booming. I believe August was the best high yield market in the history of the capital markets. So again, another buyer, our lower middle market people out here, there's another buyer with junk bonds that has the ability to borrow debt. It used to be the syndicated market, now it's the high yield market. The M&A market, just quickly, I think the interesting one about this chart, if you go to the light blue on the bottom from 2007 to 2009, and you look at $50 million transactions and below, that market actually was up last year. And it's because smaller deals are easier to finance. I can do it with less leverage. I don't need the syndicated market. It's less of a risk for my company. So in 2009, $50 million and below, which is the lower middle market, that was actually up 20%, which is pretty staggering if you think about the environment we're in for the first 6 months. And then 5 to 250 million was down 41%, and then 250 to 750 was down 57%. So the lower middle market is where a lot of the action is. This year, all markets are much better, as you can see by the far right, as M&A is up 64% or 60% overall. Then the next one is this trend where smaller is easier. So for the first 6 months, the average transaction was $211 million last year, and it was $159 million this year. So the average size, M&A is way up, but the average M&A size is off 25%. And if you look at 2002 to 2007, this is back in the world where bigger is better and bigger is easier, your average M&A transaction went from $137 million to $350 million. So the first 6-month average this year of 159 is actually down 55% from the peak in 2007. So very demonstrative of smaller is better and smaller is easier to get done, and the M&A market really has picked up significantly. These are valuation gaps between strategic buyers and financial buyers. So The dark blue is the strategic buyer, and the light blue is the financial buyer. So you can see as you go from left to right, the financial buyer became increasingly competitive with more private equity and the ability to leverage it. Peaking in late 08, you can see there's a huge difference. We were running many transactions in early 08 and 07 where the financial buyer actually was paying more than the strategic buyer. So what's happened now with the financial buyer who has less ability to leverage a transaction, he can't pay as much, which we alluded to earlier in that chart, and the strategic buyer with a cheap cost of capital can. So what you're having now is the strategic buyer is back to paying higher multiples than the private equity buyer. Next one here is just the percentage of overall M&A volume that is driven by strategic buyers or financial buyers. So again, you can see in the peak of 07, financial buyers were 36% of overall M&A volume. That has gone down each year as the private equity groups have not been able to borrow as much money. Went down to as low as 5% last year. This year it's increasing a little bit as the private equity players start putting money to work before they lose it. But one of the themes, again, is going to be the strategic buyer is going to be more competitive than he has in the last 10 years, given his low cost of capital. So just conclusions. Clearly, deals are getting done in this marketplace. This is some recent transactions with Growth Capital Partners. Freight Watch is a cargo logistics security company out of Ireland, and we did a $10 million minority investment in that. And what you're starting to see is big private equity groups who used to do majority deals will do minority deals because they don't take as much leverage. Silver Eagle, for those beer drinkers out there, this is our favorite client. But to give you an idea of the capital markets, the debt capital markets for a large company like this, in 2007, we did a refinancing. Yvonne and Jim Rebello of our office, who have a terrific relationship with Silver Eagle. We did a refinancing there, which is really a peak of the credit markets, and that was done at LIBOR plus 125 basis points. Last year, we looked at refinancing it, and the price was LIBOR plus 350 basis points. So a dramatic difference. Recently, they refinanced it in July, and it was done at LIBOR plus 200 basis points. So it went from 125, it looked like 350 last year, back down to 200 points, which tells you the credit markets really have settled down significantly over the last year. The next one is CVA, which is a cryo vessel deal that I did not work on, obviously, since I'm not sure exactly what they do. But the point of that is in 2007, we were talking to private equity players. That deal went away because of the leverage market, and we sold that to a strategic buyer at a very high valuation in December of 09. And then our last transaction that was done a few weeks ago is a minority private equity deal for an early stage energy company. And again, these are all demonstrating that the private equity is back in business and strategic buyers have to buy things to offset their slow organic growth. So in summary, we think the U.S. economic challenges are structural versus cyclical, but despite the uncertainty in the economy, some great M&A drivers that affect valuation are in great shape. One is this overhang of private equity where they have to invest the money or they lose it. Two is strategic buyers have record amounts of cash and a record cheap cost of capital. They're going to grow slower in this organic environment, and they're going to have to make acquisitions to offset that. And then smaller is better. For the first time in my 28 years, it's easier to get a $50 million deal done than a $300 million deal. And I think a $1 billion company is not going to make an $800 million risk, but they're going to make a $50 million risk in this environment. So smaller is better, easier to finance, less strategic risk, and less integration risk. And then finally, as we tell our clients, there's a lot of companies say, I'll never sell, it's going to be a long time. But we suggest to people to get ready. You never know when you're going to decide to sell that business, whether it's health reasons, whether it's a buyer has approached you. So a lot of companies, they wait till someone approaches them. They don't have those things in place to actually complete a transaction, whether it's audits, whether it's ownership, whether it's management, whether it's a board. Putting all those things together and get ready to go. It's really easy to slow down the process, and it's almost impossible to speed up the process. So with that, I'd also like to thank BoyarMiller, Gary, and Bill for letting Growth Capital Partners be part of this conference. And thank you.